Got a lot of professors on this morning. We just finished with another professor from Yale, Professor Siegel. Right. What do you think? I mean, you look at this Home Depot news, and you might say to yourself, actually, things are not so hot.
Yeah, I think all the firms are really positioning themselves very conservatively going into this year. Listen, Andrew, the way the Fed works is that a week before the meeting, they sit down, the chairman with the staff, some of the members, they discuss the latest data. Everyone's talking, listen, I will admit, I was shocked by the strength of the January payrolls. But by the time the March 22nd, 23rd meeting comes along, we're going to have the February payrolls. In fact, October 8th, we're going to have the JOLTS report. That's going to be really important. On October 10th, we're going to have the February employment report. Very important. If we see a big slowdown there, I think Chairman Powell wants to go 25. However, I will say, if it's as strong as we got in January, 50 is definitely on the table. I don't think it will be, but certainly, January was a shocker in terms of how strong that labor market is.
Are you surprised? Are you surprised the equity markets have moved the way they have? I mean, given the sort of cross currents that we've had, not great news. What'd you say?
This is the interesting thing. At the same time that this makes rates higher, it also lowers the probability of a recession. So it is more likely that the earnings estimates are going to be realized than they were before. So don't forget, stock prices are a fight between the numerator, which is earnings, and the denominator, which is interest rates. So the strong payroll report is, wow, we could have a strong consumer. We could have GDP going up much more than the Fed expects. We could have earnings really being realized instead of everyone saying, oh, going to be down to $200 or $180 or whatever. And so that numerator went up. And of course, they said, but that means the Fed might tighten. And that's why you really saw almost a standoff on the stock market. Now, not the bond market, because the bond market doesn't care about earnings. They only care about interest rates, the Fed, and what's going to happen to inflation.
You want to own bonds right now? Take a look at the treasuries. Right now, we're on the 30-year, 3.925, 2 years at 4.665. You go online, and some of these banks and online firms are offering some pretty interesting rates. Let's call them.
Yeah, and the rates are going. I mean, listen. Everyone's talking about the PCE. I mean, that's coming out Friday. It's going to be hot. It's, I have to admit, it's not going to be a good number. So everyone's going to be beating that higher rate, inflation isn't under control scenario. While when I look at, on the ground indicators, commodity prices are still going down. Gas, oil are still going down. The housing indicator, Zillow apartment rentals going down, Case-Shiller going down. I still see a lot of disinflation. It does not show up in these lag statistics, such as the PCE deflator, the CPI. We know that Powell is now acknowledging that those contain lag data. That's why he's talking about housing in his statistics. And the service sector is always going to be the last to go down. Remember, the Fed only started tightening 11 months ago. To start panicking because it's not down to 2% in 11 months, I think is not waiting for the cumulative effect of monetary policy that Powell and the Fed itself has admitted is yet to be felt. That's why I urge caution.